the nice part is this is where the ultra wealthy see the highest demand for investments, and something that we don't always get is maybe what you actually are actively looking for. And that's something that's very huge, because a lot of times there might be deals that you're interested in, maybe ones that that's where you made your exit, or maybe where your family made the money from, or it might be something that you have no interest in at all. But people out there might not know, or people who are listening on the live stream, they might not know what you're actively looking for. So maybe we can just go down, we'll ping pong a little bit, but just do a little bit of insight of sort of what deals you're actively looking for, what you're looking to invest in, or maybe service providers that you're looking for, or that the families that you work with are currently looking for, but sort of what you're currently focused on, if that makes sense. But Arya, why don't we start with you?
Yeah, so I'll bring up my background briefly, and it has to do with what we're looking for. So I was on the institutional side, on the real estate. I worked at Starwood Capital Group. If you know Blackstone, it's similar structure to them. Very time horizon focused, 3 to 5 years, financial engineering deals, focus on leverage, focus on IRR. And I think the new normal that we're entering with higher rates is a lot of families, including ours. Right now, 98% of our capital is in money market account. We switched it recently. We're in 3-month treasury yields and 6-month. You're getting 5.5% bonds. Really risk-free. Sure, there's no appreciation component, but you're not getting state tax. So that 5.5% yield equates to, in the real estate world, like a 6.2, 6.3 cap rate. So if you look at the world right now, I think the last 13 years has been people have been spoiled, low rates, and it takes a while for private real estate people or people in VC or private equity to come to terms with 7 cap rate. But that's the world that we have to go to, but real estate's a lagging indicator. So it takes time for the market to settle, for the bank rollout and the bank hit to affect all asset classes, for the big institutional guys like Starwood, like Brookfield, like Blackstone to start selling off their portfolio because their fund life is coming due. So I think, what we're focused on is 7 to 10 year holds, all cash acquisitions, basis driven. We don't care about cap rate right now because who knows what the tenant profiles look like and their health, whether it's a multifamily tenant, an industrial company that's operating that space. But basis is forever, yield's temporary. On the VC side, it's who are the founders, right? Can I trust this person? Do I believe that he could run a business? What does the management look like? I'm not in that business of AI. It's well beyond my knowledge. All I know, my career is institutional real estate and relative value. But on the AI side, on the VC side, on the corporate private equity side, what is the basis of their business? What's the TAM, total available market? And it's the same thing in real estate. It's buying deals in well-located pockets of town, barriers to entry, no new supply coming on in the next 2 to 3 years. And I think what's happened over the last 3 years or so, especially, was irrational exuberance. People, I studied in college a lot of behavioral psychology, how people make decisions, and it boils down to fear and greed. Greed was, taking people, making, basically the center of people's investment decision and putting money out. And as a small family office, we're not small, but as a family office and other groups here, we're just a small little portion of the institutional world. And everything has been, you have to look at how the big institutional players are allocating money, and everyone follows the herd, and they're the ones that are moving the markets. So when irrational exuberance was occurring, we stayed back because the basis wasn't favorable. We were in negative real rates, and the math didn't check out. So long answer short, basis driven, location focused. Can I trust the founder? What's the TAM as it relates to the VC deal, the corporate private equity deal? And if we're putting on debt post-close, really focused on very low leverage and being able to stomach any market downturn. So.
Perfect. No, thank you. How about Gary? What about yourself?
Well, I have three things to talk about today, and the first is the elephant in the room, which is Treasury bills. That's a tremendously in-demand product, and all the families that we work with, they want them. I did a 4-year ladder in my PA, and people were saying, "Why'd you do that for?" I said, "Well, I wanted to nail down some rates for a longer time." They said, "Oh, that's crazy." Anyway, that's the first thing that's under huge demand. The second thing we see is people thinking now they're an expert in real estate, and now's the time to buy distressed real estate. And I don't know how much of that's really going to be. If you're in the office market, yeah, there'll probably be a lot. But that's a game for people that really know what they're doing and have extremely deep pockets. On the private markets, because we don't see any people much increasing their exposure to public markets. It's just kind of there. We're there where we are. We're going to participate in the market, but we're not. That's not really our focus. So the demand for private market products continues to grow. And I'll give one example. In the private equity side is we invest in funds as well. At the K Fund is our fund. We do direct deals and invest in other funds. And so what are we looking at is we're looking at deep expertise in somewhere we want to be. Not a generalist, but if we want to be in insurance technology, a real laggard, or property management, a real laggard industry, we want to be in with people that are plugged into the industry, know what's going on, and they're not going to make rookie mistakes like we would probably make if we tried to go into an area that we didn't know very much. So we're looking for people that have that expertise, have access to deals, and also willing to play ball with us so we can co-invest with them.
Any top 3 of those areas, though, that you're looking to be?
Anything information related to healthcare.
Okay.
That does not have the words FDA approval in it.
Okay.
Our mantra is we see a tremendous opportunity for investing in companies that use information to do things better. And one of the really tremendous fields is going to be in healthcare, whereas last century was the information age. Mm-hmm. I think this century is the age of biology made possible by the information age. And on my Garmin watch, I am now checking for defibrillation here while I'm on the panel.
Oh, perfect. Raymond, what kind of solutions are you looking for?
An important component to maybe add for everybody is every one of the families we work with is first generation. So they created the wealth. Our clients range from $40 million to about $11 billion. Well, the things that we're looking at today and the things that we actually can enjoy doing today, because we have real clarity around all of our exposures, is we've moved the families have moved largely away from investment deals with the major firms out there. Unless we can get special terms. So we can get co-investment terms, which sometimes the families can. We'll go in with the major asset managers and private equity sponsors. More of what we're doing is we're partnering up with other operators, where the operator's writing the largest check in the deal, and we're filling out the deal. A couple of deals we've worked on recently were with a group out of Dallas, taking a company private. They were writing a check for $175 million and looking for another $150 million. So we filled that pocket for them. We developed, we put about $100 million to work in staging areas for truck fleet industries around the Sun Belt. So things like where these Amazon trucks need to sleep every night.
Yeah.
We've done some deals recently with taking private FBO facilities for private aviation terminals and going to sale leaseback provisions with folks like Chevron. So we like things where we can put permanent capital to work. We like things where we have long-term yield plays. We don't really want our money back. We'd rather keep that money out and keep it working and find other places to do different things. So a lot of what we've done of late, we've worked on a minerals deal with a group out of Dallas, Spicewood Minerals. They're fantastic. The founding family behind NCAP, which is a large energy private equity firm, put that together with a couple guys from Blackstone, guy I used to work with in charge of prime brokerage at UBS. love their product. We're earning 28% yield on the first fund that they put to work. So we're looking for things that really aren't very popular. We don't suffer from fear of missing out. We have one client with exposure to crypto, and the only reason he does is he's a commodities trader and he saw volatility and he fell in love with it, and so he trades it on the futures market. So, we're kind of odd ducks.
And do you see that as a trend, though, on those first-generation single-family offices that you work with, or is that just something where you found synergy and where you guys landed on, or is that a trend you're seeing?
I think it's a trend, but it's also something like I had the luxury of an observation point for 15 years. Mm-hmm. So, lending somebody $800 million, I had to go hang out with them when I was at UBS in my time there. And so we have really pretty nice intimate relationships with a lot of cool people. But the trend with these folks that I see is a lot of the private equity industry, which I think is going to change because of technology right now. There's a lot of cool fintech going on. It's not designed for taxable clients. And the taxable clients are fatigued with the likes of Schwartzman getting so much richer on their money. And if it was only 2 and 20, that would be okay maybe, but it's a lot more than 2 and 20. So we've certainly seen a tectonic shift of, and Texas is a really weird place. If you've not spent time there as an investor, there's all these Texas mafia guys, and they're all doing deals with each other, and there's like 7 sects of them in Dallas, and the Houston people are different, the San Antonio people are different, Austin's just LA. So there's a lot of really interesting things going on in between all these different units. But we also work with families in Mexico, Panama, Puerto Rico, Hong Kong, and Canada now.
Okay. I love the diverse answers so far. Kip, how about yourself?
Well, I'll give you a little background because it kind of sets the stage for the comment I'm about to make. But in addition to what I just shared with you, for 11 years, I was a vice president at Bank of America and headed up a real estate department at one of the large branches. And then I spent 15 years as a commercial developer, building shopping centers and office buildings and industrial parks. And again, today I am a registered investment advisor, which puts me in the position of being a fiduciary. So I have a responsibility to the clients to make sure that they are diversified. We are in real estate. Predominantly right now, and usually we're going into limited partnerships and looking for people who are putting those limited partnerships together. Right now, our focus is primarily in self-storage, certainly single, multi-tenant, and maybe medical. We've shied away from commercial and office and industrial right now. Industrial, maybe we would pick back up. But we're also broadened into, we do life settlements. We're doing some currency trading with somebody that does that for us. So, I mean, we have to be, because of our fiduciary relationship, we have to be looking at diversification. And a lot of times a family office would come to us and they have a lot of real estate already in place. So we're obviously not going to probably move them into more real estate, but we do want them to start thinking about other things. We also do some private equity. Some of it we can do through the Family Office Club, and that's the reason we're a member. Also, we're a member of a group called the Keiretsu Capital. They do private equity deals. So it's just a matter of looking at the diversification, what that family has, and what we need to do in order to supplement what they're doing. The other thing we're doing a lot right now, you were mentioning treasury bills. We're doing treasury bills. We got the money market right now. We're getting 5.23% on a money market. And we've been doing structured notes, and I won't go into a lot of detail on what those are because they're a little complicated and there's some risk, but we've been getting right now somewhere between, on a low side, 12 to 17% on those. And we only do them for 9 months. Because we can roll them over, and we like the short-term aspect of them. We don't want to tie them up for a long period of time.
Perfect. Thank you, Kip. So we talked a lot about what you guys are actually actively looking for, things that you're interested in, and your background. But what's the number one thing that you actually look for in the team that you're working with? So the one that you actually decide, the pony you decide to back. Like, what's the number one thing that you're actually looking for from that team as a trait? And then number two, how do you actually assess or test it? So not just how are you looking for it, but then how are you actually testing those assumptions that really, led you down that route? So why don't we start with you, Raymond?
Yeah, we look for really good operators. We look for people that have a lot of skin in the game. We don't really do anything with fundless sponsors. We don't like people that are slinging ideas that don't have a substantial amount of capital in it. We sit in a really luxurious position with the connectedness of the different families of people we work with, so we can JV with like Pritzker Private Capital on deals and different folks out there. So a little unique for us is that we want to go in with somebody who's writing the biggest check, right? So for us, if we're going into a lot of directs, we sit on, generally speaking, about 55% alternatives on average for our families. So we have one family that's worth $12 billion. They have $400 million of public market exposure.
Okay.
Everything they do is sort of oriented around the controlling business that they started, which is petrochemicals. So diversification for them is buying a PVC manufacturing business.
Okay. Arya, how about yourself? Either on the VC side or on the other side, what's something that you guys look for as that number one trait? And then also, how are you actually testing that?
Yeah, piggybacking off of what Raymond just said, that's exactly what we're looking for. Downside protection. Upside and base case, I mean, who knows if any of your base cases are correct. Underwriting is underwriting. One little tweak on, at least in the real estate side, exit cap, 25 basis points, makes or breaks a deal for a lot of groups. We like skin in the game, downside protection, and that's exactly what I was mentioning earlier. Basis, location. I hate saying it, but everything boils down to the basics. It's the world that we live in. It's the world that makes sense economically. It's what we're all taught in school. And because of the market that we've been in the last several years, let alone the last decade, people forgot about that and kind of made fun of that terminology. Skin in the game is really, really important. In any one of our deals, we actually don't like to overcomplicate deals. So actually we prefer, we've been looking at deals on the co-investment side instead of being cute with GPLP structure, where our family would be putting in substantial equity alongside the other group. Sometimes, I'm young and, my father is the one that made the wealth. So I'm out looking for deals. He's kind of on the sidelines and I'm showing him deals. People show me deals. And I tell people, let's let the deal do the talking. This 95-5 GPLP structure, excuse my language, fuck that. I think whoever's fee oriented, worried about a pref or the promo after a pref, I think they're losing sight of the genesis of what a deal is. And that's why I left Starwood. That's why I left the institutional world. He actually broke my nose out. It was an analyst versus MD basketball game pickup at the Greenwich YMCA, and I was guarding Barry, and he broke my nose.
True skin in the game. Yeah.
Talk about skin in the game.
Real skin in the game.
Yeah, real skin in the game, real blood on the ground. But yeah, I think that's pretty much it.
And I guess it might be a general question. Is there a threshold, though, of how much skin is in the game? Like, is there something they're actually looking for when someone's like, yeah, no, I'm invested, I'm part of the deal? Like, is there something that you're like, no, we're not 1 or 2%. You need something more.
One size fits all. I don't think there's.
Is there anything that would like not meet the threshold if it's any percentage? If it's below this or below amount?
Less than 10% or less. I think they're throwing in, a prior deal promo or a fee. I don't like that.
Yeah. And each one's going to be different, but just in case there is something.
I honestly think it's just the world that we're living in right now is we're higher rate for longer. I think that we're going to be in a healthy economy going forward. It's going to be 2 to 3. The Atlanta Fed is projecting, I'm rounding the numbers, I think it's 5.3 or 5.5% GDP growth rate for Q3. How can the Fed cut rates? 1. 2, that's a healthy economy. 3, because of that, the Fed can't help but not stop quantitative tightening when you don't sell, when the government, when the Treasury Department is selling notes that have to increase yield to incentivize buyers to buy that paper, and they want to bring down asset values. the individual investor, the individual person who owns that home is fine because they're sitting on a 2.8, 3% mortgage. 90% of people out there that own a home have a 5% mortgage or less. So the US of A, we're in a healthy economy. That's why we're all here. That's why people are looking for a capital. And because of that, we're going to sell on these higher rates for longer. And EBITDA multiple expectations have to come lower. If it's a SaaS business, if it's priced on, what the revenue is, the days of 5x revenue are gone. The days of buying a 5 cap to get to a 3.5, 4 cap to get to a 6 cap are gone. Now people are trying to buy a 5.5 cap to get to a 6.5 cap. I don't know what future growth will look like. So it's, what do I know today? That's my basis. Sponsorship. Do I trust the person? Yeah, I think skin in the game.
No, perfect. Gary, how about we go to another question, though, for you? Different topic, going towards the end of it. But tell me this, what do you prefer? Fund investments, direct investments? I know a lot of the families that we work with, we know sort of what their appetite is, but yeah. Is there one that you prefer or one that you're looking at now more than the other?
No, it's a system for us. Is we, like a lot of family office groups, we don't really have a large office. So what do? What do the great families of the United States and Europe in particular do? Is they build a system. And how do you build a system is partly you can do direct investments, but also you can invest in funds that provide expertise you don't have and basically deepens your bench so that you're more effective across the entire portfolio. So we've done that, and along with co-investment opportunities, the fees are in line with any other type of fund investment. So we're looking for, in the funds, we're looking for specific expertise, contacts in an area, like InsurTech. So we go into that area, which we like. We know we're with people that have been down that trail before, have gotten bitten by rattlesnakes before and have recovered. And so that's the system that we use to hopefully achieve success continually.
Okay. Kip, how about yourself on the actual fund side or direct investment side? Is there something that you prefer? And if you prefer both, and it's sort of a system, is there actually an allocation that if you were to look at your own, that's 60% one, 40% the other?
Yeah, the answer is, again, diversification. So we want to be diversified by sponsorship. We want to be diversified by product. And going to your comment, we're probably going to lean towards a fund or limited partnership type of relationship where there's more. So if I stay with real estate, they don't have one property. They got 10, 12, 13, 15 properties. If we go to life settlements, they're going to have a whole portfolio of life settlements, not just 1, 2, or 3. So again, for us, diversification, that's our fiduciary responsibility and what we bring to the table, and we just got to constantly focus on it. And so a large part of what we're doing is, again, one of the reasons we are members of this group, also, as I mentioned earlier, the Keiretsu Capital. I don't have the expertise or the time to source a deal and then go do all the due diligence. I don't have that capability. So I have to rely on sponsors who do this day in and day out and who I have comfort that have done the due diligence properly and can acquaint me with those kind of deals that we can put a client into.
Okay. No, thank you very much, Kip. Do we have any questions from out in the audience? Oh, question in the back? Oh, all right. Oh, yes, right over here. We'll bring Jacob over to you.
Hello, this question is for Aria, but anybody else on the panel as well. With the rising interest rates in regards to real estate, where do you see rental growth? Or, I don't want to lead your question, but where do you see rents going?
Rents? Like apartment rents? It's not a one size fits all. So, it goes with supply. Markets like Phoenix, Atlanta, it's all the Sun Belts to be simple, have a ton of supply. I mean, we have 950,000 units that are going to be delivered. Don't quote me. I think it's over the next 12 months nationwide, 18 months. household formation, when economy is kind of like just humming along, slows down. So what happens? Vacancies go up, concessions go up. People forgot about. I remember. I don't think I've seen a model where people really underwrote concessions. I feel like people forgot what free rent is. I'm now seeing apartments in Phoenix with 2 months of free rent, Class A in Chandler. Chandler itself has 3,000 units under construction. So even within Phoenix, you can't just paint a broad stroke. Scottsdale, as a percentage of inventory, very little supply compared to downtown Phoenix, compared to West Valley, which is Tolleson, Glendale, Buckeye, Southeast Valley, Gilbert, Mesa. I think in the West Valley, inventory is increasing by 75%. So you mean negative growth? Negative rent? Negative rent? I don't know how you describe it. Rents are going down. A lot of groups are doing 0% rent growth. I think it's negative. On top of that, at least a month of free rent. On top of that, not 5% vacancy. Maybe it's 7 or 8.
Can I ask you a quick question? We think there's going to be a huge opportunity for buying into this multifamily because all these guys are getting their face ripped off that never did it before, raised a bunch of money, and their interest rate caps weren't reset, and they're screwed, blued, and tattooed. What do you see? You seem to know this.
Yeah, no, I started my career at Starwood. We were buying value-add multifamily in 2013. I don't think I saw daylight, like physically. I saw my pillow, Starbucks Frappuccinos, like, the ones you get from the store. We were buying up portfolios from Sam Zell, Gables, Cortland, at really cheap prices. At the time, it was like a 6.5, 7 cap. I am actually, us and another family, we threw in an offer this afternoon on a Class A, Class A. Brand new, C of O, delivered in January, 80% occupied. They've offered 2 months free on 75% of the rent roll. I'm seeing a lot of opportunity in the Class A space. This deal, the price point is January of 2019 levels. When I was on the institutional side, I was buying Class A product for high 200s a unit. This same deal just down the street, there's a comp for 480 a unit. Offers, I was just on my email before I got here, are in the high 200s a unit. That's crazy. Class A product, let alone the B and C. One of my really good friends in the industry, he started his multifamily investment firm, focusing on Salt Lake City, Nevada, and Phoenix. The first deal he bought, he just sold for $1 million above the note. His basis is $43 million. His purchase price is $43 million on 170 units. Class C product, Class C location. He pummeled in another $3 million of CapEx for the renovation scope. He just sold it for $36 million. This is a week ago. And he's one of my really good friends. I talk to him all the time. Never really talked about it. He's like, oh, I'm fine. So whatever you see in the headlines, you have to be careful. Don't paint a broad stroke. I think that the asset class, aside from office, because office is systemic issues, that is going to be really interesting is multifamily. And people have to be careful with these growth regions. And I think that I have a lot of experience in just Phoenix itself. I've not bought a single deal there since 2018. And I've seen a lot in Phoenix. And now I'm finally smelling opportunity. If we spoke a month ago, would not have said the same.
Let's give our panelists here a little round of applause, though. Thank you so much.